Most investors either chase the hottest stock or they end up stuck holding losers for years. But what if there's a proven way to only stay in strong assets while avoiding the weak ones? That's the power of dual momentum investing, a strategy that has beaten buy and hold for decades. In this video, let's break it down step by step. Momentum simply means this. Assets that have performed well recently tend to keep performing well in the near future. There are two main types of momentum. Firstly, there is relative momentum, which is comparing assets against each other. For example, US stocks versus international stocks. And then there is absolute momentum. That is comparing an asset to its own past performance. For example, is the S&P 500 doing better than what it was doing, say, 6 months ago? Why does it work? Because of human behavior, herd mentality, and the fact that big institutional money tends to follow trends. So what makes this strategy dual momentum? It's the combination of relative momentum and absolute momentum. Here's how it works. Step 1. Compare US stocks with international stocks. Invest in whichever has higher momentum. Step 2. Only stay invested if that asset's performance is also positive compared to risk-free assets like T-bills. If neither passes the test, you move your money into bonds or cash. It's that simple, and it keeps you invested in strength while protecting you during nasty crashes.
This strategy was popularized by Gary Antonacci in his book Dual Momentum Investing, and the research is clear. Since the 1970s, dual momentum has consistently outperformed buy and hold with smaller drawdowns. For example, during the 2008 financial crisis, dual momentum shifted investors into bonds, helping them avoid the worst of the crash. It's not about predicting the market, it's about systematically following strength and stepping aside when risk is high.
But, like every other strategy, there are pros and cons. Let's talk about the pros first. Clear, rule-based system, lower drawdowns, no need to pick individual stocks. What about the cons? Requires patience and discipline. In strong bull markets, it can sometimes shift to safety too early and underperform.
Here's how you can try it yourself with ETFs. Compare the S&P 500 ETF, ticker SPY, with an international ETF, ticker VEU. Invest in whichever has higher 12-month momentum. But if both are underperforming T-bills, shift to bonds like IEF or short-term cash equivalents. Rebalance once a month and let the rules guide you. Dual momentum isn't about guessing the future. It's about protecting your capital while compounding with strength. If you'd like me to show you how I backtest and apply this in Indian markets, drop a comment below. And if you're serious about mastering systematic investing strategies, check the description for details on my one-to-one mentoring. Don't forget to like this video, subscribe, and share it with someone who wants smarter investing strategies.